How to invest your first 10,000 in 2025. Imagine this, you've got $10,000 sitting in your account and you're not just looking to keep it safe, you want to grow it. The question is, where do you put it? Stocks, real estate, index funds, or maybe high-yield saving accounts? The possibilities are endless, but which option gives you the best chance to multiply your money? Let's break it down. Hey everyone, and welcome back to the EODHD channel. Deciding how to invest your first $10,000 can feel like a big decision, but it doesn't have to be complicated. Today, I'll show you how different strategies, stocks, real estate, and more performed in 2024, so you can confidently plan your 2025. Stick around to find the best fit for your goals. Deciding on the right investment strategy means understanding your options. Whether it's riding the growth of leading companies, leveraging the stability of real estate, or exploring other financial tools, each part offers unique opportunities and risks. Today, we'll uncover the numbers and show how to build a strategy that might work for you. Imagine this, you have $10,000 to invest, aiming to grow your wealth. You might consider putting all your money into a single stock, hoping for substantial returns. However, this approach carries significant risk. Take Intel Corporation as an example. The company ended 2023 on a high note, with a strong momentum and optimism for continued growth in 2024. Many investors saw it as a solid choice, expecting further gains. But then things took a sharp turn. Intel faced unexpected challenges, and by the end of 2024, its stock had plummeted by 60%, making it one of the worst performing stocks in the Nasdaq 100. Now imagine if you had put all $10,000 into Intel at the start of the year. By year's end, your investment would have shrunk to just $4,000. This highlights the importance of diversification, spreading your investments across multiple stocks to reduce risk. To mitigate such risks, it's prudent to diversify your investments. Let's see how allocating your $10,000 evenly across 7 different stocks could have performed in 2024. By investing approximately $1,428 in each, here's the outcome. You can see it on the screen right now. When we add it all up, your $10,000 turns into $15,096 by the end of this year. That's a total return of 51%, and that's without accounting for dividends, which could have boosted your earnings even more. Diversifying your investments across multiple stocks reduces the impact of any single stock's poor performance, leading to more stable and potentially high returns over time. Stay with us, because up next I'll explain why these specific stocks were chosen and the strategies behind this portfolio. Excited to see how this compares to other investment options, or how diversification can help reduce risk while still aiming for solid returns? Yes, we've got plenty more to explore. So, now that we've seen the numbers, let's talk about why these 7 stocks made the list and how this portfolio was designed for balance and growth. First, let's address the elephant in the room, the dominance of tech stocks. Four out of the 7 companies, Amazon, Nvidia, Apple, and Tesla, are from the tech sector. Why? Because these companies aren't just growing, they're driving the market. In 2024, we saw a major boost in tech sector, largely thanks to innovations in AI, cloud computing, and consumer electronics. Stocks like Nvidia and Tesla were leading the change, with Nvidia's 173% growth being nothing short of phenomenal. When building a portfolio, it's important to recognize trends like this and allocate a significant portion to sectors that are performing well. But here's the catch. Tech stocks tend to move together. When they are growing, they lead the market. But when they fall, you can drag your entire portfolio down. For example, during a downturn, macroeconomic factors like interest rate hikes often hit tech stocks the hardest. That's why diversification across sectors is crucial. Here is another important point. Dividend-paying stocks. ExxonMobil, Procter & Gamble, and Caterpillar all pay dividends, which means you're not just relying on price growth, you're also earning income along the way. Dividends are like a safety net. Even during flat or decline markets, they provide consistent returns. Meanwhile, analyzing dividends and fundamentals is easy with EODHD APIs. You can access data on yields, payout ratios, and more without needing the code. With integrations for Google Sheets and Excel, you can quickly pull financial data, analyze trends, and make smart investment decisions. By combining growth-oriented tech stocks with stable dividend-paying companies from other sectors, this portfolio strikes a balance between high risks and stability. It's a great reminder that even when trends favor one sector, it's important to diversify to protect your investments. Next, we'll compare these stocks to other popular investment options like real estate and index funds to see how they stack up. Let's start with index funds like SPY, which track the S&P 500. In 2024, the S&P 500 grew by 23.3%, meaning a $10,000 investment would have turned into $12,330. While it's not as high as some individual stocks, SPY's diversification across 500 companies provides stability and broad market exposure, a solid foundation for any portfolio. Real estate offers another great way to grow wealth, especially for long-term investors. In 2024, property values grew by an average of 8 to 12% depending on the location. A $10,000 down payment on a $100,000 property could yield significant equity gains over time. Plus, rental income can generate cash flow. However, real estate comes with higher upfront costs like taxes and maintenance, and is much less liquid than stocks or funds. For those seeking safety, high-yield saving accounts delivered interest rates of around 4% in 2024. This would turn $10,000 into $10,400, a low-risk option but one that barely keeps up with inflation. Saving accounts are better for short-term goals rather than long-term wealth building. Let's summarize the results for $10,000 investment in 2024. Individual stocks grew by 51%, turning your investment into $50,096. The S&P 500, tracked by SPY, delivered a growth of 23.3%, increasing your investment to $12,330. Real estate saw growth between 8 and 12%, with the added potential for rental income. A high-yield saving accounts provided a growth of 4%, bringing your total to $10,400. While stocks offered the highest returns, they also carried the most risk. Index funds provided a balanced growth option, real estate delivered long-term stability, and savings accounts offered security but limited returns. The best strategy often combines multiple options. For instance, you could invest 60% in individual stocks, 30% in index funds like SPY, and keep 10% in a high-yield savings account for emergencies. Or if you're focused on the long term, adding real estate to your portfolio could provide additional diversification. How would you split your $10,000? Would you prioritize growth, stability, or a mix of both? Share your strategies in the comments, and if this video gave you new insights, hit the like button and subscribe for more practical tips on investing and building wealth. And don't keep this video to yourself. Share it with someone who's also figuring out how to make the most of their savings. Thanks for watching, and I'll see you in the next one.